This is the second module of the discussion regarding agricultural loan underwriting. One of the things that we have talked about is when one of the components of the 5 C's of credit is collateral. Collateral valuation and documentation is very important. Collateral being defined as property that plays as security for a loan, and that pledge of collateral adds safety to the loan. The lender may sell the pledged collateral to obtain payment if the debtor fails to pay. Therefore, it is important that we identify collateral when we're making a loan, and we document that as being the collateral and what the valuation would be. For collateral to be acceptable, it needs to meet the following requirements. In other words, we have to be able to identify the collateral. There needs to be a description of the collateral, and if possible, if it has a serial number, certain equipment that you might take as collateral will have a serial number that needs to also be recorded. The collateral needs to be relatively non-perishable. Perishable collateral is not acceptable because it could go bad, spoil, not be available at the time that the lender needs to access that collateral to satisfy the loan. Collateral needs to be, you need to be able to establish a reasonable estimate of value. This can be done through looking at sales of this collateral in the market. Oftentimes on equipment sales, there are services that will publish values for used equipment based on farm sale information. This can be used to establish what the value of that collateral is. The collateral needs to be in saleable condition. In other words, if the collateral is not, if you have to address it and you have to take possession of the collateral, it has to be in a condition that it is saleable. Oftentimes, this is one of the reasons why you want to have collateral inspections to make sure that the collateral is being maintained. So it has to be able to sell and have a market for that. Again, there needs to be an established market for that collateral so that if the lender has to take possession of the collateral, they can take it and sell the collateral. Now, collateral evaluations, the current values of the collateral should be established when the loan is made. There needs to be periodic reevaluations of the value of that collateral over time. The frequency of which reevaluations of value of collateral needs to take place really kind of depends upon the price volatility of the asset. In other words, if you're looking at equipment, the reevaluation of that equipment's value may need to be on a year or 2-year basis. If you're looking at other types of collateral, it may need to be more frequent. But you need to be able to have some program or established procedures to go out and monitor the collateral and reassess the value. Now, we document collateral values and related to the location and identifying details of the collateral. We document that as a fair market value as of a specified date and what source we used in order to calculate the estimate. This documentation is important for lenders who have to meet certain regulatory requirements. You've got regulators that are coming in and examiners that are coming into the bank, and they're looking at the documentation in the file, and the collateral values and these types of information need to be up to date. A lien is a charge upon property for the purpose of securing the payment or discharge of that debt obligation. Whenever you establish a security interest in property, you will establish a lien. Now, the methods of obtaining that lien vary by the type of collateral that you're talking about. There's 2 types of collateral: chattel, which is personal property, and real estate or real property. Chattel, again, is an item or an article of personal property, such as livestock, crops, and equipment. And then real property or real estate is immovable property, such as land, buildings, improvements, and appurtenances to that land. A chattel lien is established upon using the Uniform Commercial Code, or UCC. There's a set of guidelines. It's been adopted by 49 of the 50 states. The UCC in Texas, the filings are made with the Secretary of State's office, and they're generally referred to as UCC-1 filings. The reason they're established through the Secretary of State's office is that allows anyone to look at what liens may be on personal property. So there's one general source for that. The description of the property secured under the UCC-1 must be reasonably specific and current, meaning that they periodically expire and must be refiled. Just saying we have a lien against all a person's equipment is not sufficient. There needs to be some reasonably specific description of what that equipment is or what that collateral is. Now in Texas, when we talk about real property, the security interest in real property is established through a deed of trust. The deed of trust is a three-party document where you have the lender, the borrower, and a trustee. The purpose of the trustee is to make sure that if the lender exercises a right of foreclosure, that it is done in a proper manner. There's certain rules that they must follow in order to foreclose on real property. The deed of trust is filed in the county clerk's office in which the real property is located. It's in effect until the release of that property, where it's executed by the lender and filed. Where a chattel lien or UCC-1 filing has an expiration date, the deed of trust does not. In other words, it will be there until there is a document filed with the county clerk that terminates that deed of trust. Credit risk management on the part of the lender is oftentimes accomplished by requiring protective covenants within the loan process. In other words, there are certain things that the lender requires the borrower to do as part of their loan underwriting process, and the conditions that are placed upon the borrower through these covenants mean that they must comply with in order to adhere to the terms of the loan agreement. If the borrower does not act in accordance with the covenants, the loan can be considered in default, and the lender has a right to demand payment, usually in full. Now, banks usually add covenants in order to accomplish the following objectives: to maintain the quality of the loan, to keep adequate cash flow, preserve the equity that the borrower may have. In a borrower with a known weakness in his capital structure, a covenant can be used as a measure to improve this weakness, requiring, for instance, a certain level of working capital is oftentimes one of the requirements. And to keep an updated picture of the borrower's financial performance and condition. Oftentimes, in these loan covenants, certainly one of the main ones is just to require that the borrower furnish periodic financial information so that they can keep the loan files up to date. There may also be restrictions relative to their marketing of product, where they can market it, where they may have to have the permission in order to do certain things. And so there's a whole host of these types of covenants. They may relate to the requirement to purchase insurance, hazard or crop insurance. If you buy a new car and borrow the money to purchase that car, your lender is going to require that you have insurance on the car, so that if the car is damaged or wrecked, then the lender has a source of repayment there. Same way with crop insurance. Most lenders are going to require that borrowers that are borrowing money to produce crops are going to have crop insurance. The covenants may also require contracting. In other words, they may have a provision there that you have to contract that commodity within a certain amount of time. Oftentimes in the livestock industry, they'll within this maybe 30 days after the let's say cattle are put in the feed yard, there may be a requirement that they be contracted. There may be hedging requirements to require you to either buy options or to hedge. Sometimes the bank will require compensating checking account balances. In other words, a minimum amount of money that has to be kept in a checking account over time. And then, of course, the requirement to provide financial information on a periodic basis to make sure that everything is up to date. Now, the lender is going to monitor the loan over time. It's critically important and a component of the lending process. Collateral inspections and reappraisals are done. Evaluations should be performed on a regular basis by qualified personnel. Should have a periodic review of loan documentation. It's important to ensure that up-to-date financial information, any security agreements, any UCC filings, credit reports are maintained on an updated basis in the borrower's file. Banks in particular are regulated by the FDIC and then state or federal banking organizations, and these they will have periodic examinations, and so those examiners will come in and pull loan files and examine those files to make sure they're up to date.